Hello friends, you must have heard something about minimum alternate tax, that is MAT. We will be discussing this today in this episode. MAT is a type of tax on income. So it's a part and parcel of Income Tax Act. We all know that income tax is tax on the income, and the income of a company is decided on the basis of profit earned by the company during a particular year, and the profit of the company is worked out on the basis of principles of accounting as well as the provisions made in the Companies Act, and these accounts are audited and placed before the company's board meeting. They are accepted by the board and then are subsequently accepted by annual general meeting by the shareholders. So the profit which is worked out in the profit and loss account is as per the accounting principles as well as according to the provisions of companies law. However, the profit that is worked out by this is called as book profit, and this includes various provisions of Companies Act only. So that book profit is the profit which appears in the books, from which the dividends are paid, from which the tax is paid and all. However, the Income Tax Act has made certain different provisions for finding out taxable profit. I'm sure you must have noticed two terms. One is book profit and another is taxable profit. What is the difference in the two? As I said, book profit is as per accounting principles and following the Companies Act provisions, whereas taxable profit is subject to adjustment of that book profit for various concessions, deductions, exemptions, incentives given by Income Tax Act. Many times the provisions of company law and the provisions of income tax may be different. For example, depreciation. The rates of depreciation on various assets given by Companies Act are different from the rates of depreciation prescribed in the Income Tax Act. So while making the final accounts of a company, the provisions of companies law will be followed, where the rates of depreciation are less as compared to income tax provisions. So while finding out taxable profits, well, depreciation at the rates prescribed in the Income Tax Act will be applied. So adjustment of profit is required to be made for the increased rate of depreciation, by which the profit will come down. Same is the case with deductions. The Income Tax Act has allowed some deductions for finding out taxable profits. Some concessions are given. Some incentives are given, some exemptions are given. Exemption is that head of income is not liable to tax, that is exemption. Deduction is you work out the profit and make a deduction from that, and the balance is taxable. Whereas some incentives are given by the Income Tax Act. For example, if the government feels that additional investment is to be made in the assets of the company, capital expenditure, the Income Tax Act may provide some weighted deduction of depreciation once there was investment allowance. So this is additional deduction given over and above regular depreciation. For example, government wants companies to increase exports. Then in Income Tax Act, a provision may be made for weighted deduction of the expenses made for exports, or some incentive may be given, like No profit on export is taxable. So these are some of the examples by which the profit as per books is required to be adjusted for taxation purposes. So taxable profit and book profit are two different things. Many companies used to take benefit of these provisions of taxation. Until assessment year 97-98 in India, there were few companies showing book profit but showing no taxable profits by taking the advantage of these deductions, exemptions and incentives. And those companies were therefore called as zero tax companies. For years together, they could manage not to pay the tax. That was not illegal. That was perfectly legal. But they had the ability to pay, but they were by tax planning not paying the taxes. And therefore, the Income Tax Act made a provision which is called as minimum alternate tax. Every company will have to pay minimum tax if it is showing profit, if it is showing book profit. And section 115B was introduced, and that has made certain provisions for making additions to the profit as shown in the books and making certain deductions. In the book profit, if income tax paid is debited. In the book profit, if income tax provision is made and deducted. If in the book profit, some probable expenditure is provided for. In the book profit, suppose an item is to the debit side of profit and loss account, that is probable provision for losses. All such debits made to profit and loss account reduce the book profit. The Income Tax Act says all these provisions are to be added back. And then profit is to be worked out, which is called as taxable profit. So the book profit is required to be adjusted for the items which are mentioned in the Income Tax Act. With these adjustments made, the adjusted profit becomes liable for minimum alternate tax. So this is the tax which every company has to pay, even though as per provisions of the Income Tax Act, some deductions, exemptions and incentives are allowed. Now, the rate at which this minimum alternate tax is to be paid is decided by Finance Bill or Finance Act. That is, in every budget that may change. Similarly, which companies are liable to pay this minimum alternate tax is also decided by the Finance Bill, that is in the budget. Many times or earlier it was the provision that infrastructure companies, power sector companies or insurance companies are not liable for minimum alternate tax. As this is the tax which is alternate tax, a provision is also made in the law that this minimum alternate tax paid this year can be carried forward and adjusted, set off in the book profit of the next year. A simple principle of ability to pay is applied while levying this minimum alternate tax. This is logical and this is required, because otherwise, as was done before 97-98, many companies were not liable to pay the tax. Well, this is something about minimum alternate tax. Let us meet in the next week with some other such concept. Till then, goodbye. Namaskar.